Hello, this is Blaise Fabry with Chinavestor, and today I'm going to continue the comparative analysis of four US shale oil companies. This time it's the cash flow analysis. Let me switch screen and you can see what I'm going to follow for this presentation. We have four companies that have a somewhat different cash flow position. We know that Whiting Petroleum and Continental Resources are a little different from the other two, KOG and OAS Petroleum, in terms of size and also growth pattern that we covered in a previous presentation. This time what I want you to see is that their cash position is different as well. Now, let me just get rid of this first, and then first and foremost, we're going to see operating cash flows. In other words, how much cash these companies generate just drilling oil, selling oil, and just by operation. We can see that for Whiting Petroleum and is really generating the most of each cash from operations, and there's a little bit of financing. Financing is typically when companies either issue bonds or underwrite some debt, and all this income, so to say, goes into investing. And we can see there is a plateau in investment, but the good news is that operating cash flows continues to go higher. So this is a kind of a good position that Whiting Petroleum is. Now, let's move over to Continental. The company has a look at the operating cash flows again. Blue line is a constant increase. That's a very good sign. The company is generating quite a bit of cash flow. On a financing part, you can see that the company started to underwrite some debt, but our cash flow, balance sheet analysis revealed that the company is really not highly leveraged. So even though it taps that market for resources to expand growth or continue growth, the company is not highly leveraged. So all this income that they generate goes into very much into investing. So they just really investing means that they just acquire more equipment, more drilling, and they are really on a strong growth path, as you can see. This is slightly different. The situation is slightly different for the other two companies that we have here, KOG and for OAS. These are the much smaller players, and the main difference between the smaller players and the big ones, established ones, is that look at operating cash flows for KOG. It's really a tiny portion compared to cash flow from financing. In other words, the company is underwriting quite a bit of debt, and it's heavily leveraged already. That we knew from the balance sheet analysis that we've done before. So this company is already highly leveraged, yet it doesn't generate sufficient cash flows to continue with an aggressive investing path. So KOG is a big question mark how much it can continue to invest in future operations. OAS Petroleum is a little bit better. That it generated a little better cash flows from operations, which is good. The company issued debt as well, and we know that this is heavily let me just erase it, and the company is heavily leveraged already, so it really cannot issue more debt. So if cash from financing goes up and down, I expect it to go completely down or somewhat decline the curve, because it really cannot sustain taking on more debt. And then if you look at investing for this company, it's kind of aggressive plan, but again, I can see it coming back investing for both two, because they just don't generate enough cash flow from operations. And this completes this report. Thank you for listening to Chinavestor today.